The other thing for advisors who have been running, and wherever you came from, because you didn't come from Shartru, you've been running high levels of equities. I think I've got some numbers in here. I'm going to show you that dividend yields are coming back, and everyone has been laughing at the blokes over at the fixed interest team for years. Well, right now they're doing pretty well. And so strategic fixed interest and fixed interest portfolios in the MDA, they did circa 4.18% for the quarter. Okay. What we saw is corporate bond yields remain reasonably attractive, certainly against government bonds. Government bonds now are 1 and a bit percent in reasonable markets. I'm not talking about Argentina, I'm talking about US, Australia, UK. Credit is better value again, and we've made good money in that. And you might remember in March we put in significant amount of money into the credit markets because spreads had spiked out by about 11%. We've been taking advantage of that, and credit markets do look like better value. Credit spreads are coming in. One of the things I hear people say is, oh, well, there's going to be a whole bunch of defaults because of all the things I showed you earlier. One of the things that offsets that is that there's a lot of forbearance by banks, a lot of money being put into the economy to stimulate it. And the second thing, the last thing is, it's an active trade. You need analysts actually looking at it. You can't just go and buy the index. Now, just because you're actively looking at credit doesn't mean that you won't get a punch in the nose, but you are certainly less likely than you are in an index fund. And I know that there's a lot of portfolios out there across the market that are loaded up in fixed interest, and anyone that's got one of those, give me a call. But basically, a lot of them have got long duration, and you know that I've talked a lot about long duration, and I've written papers about it, and Kath and David have pushed them out there, and I'm sure they're on Spawn. We've got very little cushion between zero rates and wherever the bond market is now. We've then got corporate debt on top of that, better spread, and then we've got we've got credit. But those people who are out long duration, if rates go up, there is no interest coupon, or there's no coupon to protect your backside. So be aware. I say it nearly every call, so I'll say it again. Okay, so this is the set of numbers that I did. I did these at 4 o'clock in the morning, and you'll notice David Bowie's down there in the left-hand corner. So what I've seen is people. So what happens is you send your SOA in, or Steve Peters and Alistair are doing reviews on portfolios, and sooner or later it sort of tumbles down the hill and it ends up right here. And I open it up and I find clients with 90% equities and what have you. And then when we start talking to the advisors, they say, oh, well, fixed interest rates weren't very high and I had to get income. Well, every dog has its day. And the boys over at fixed interest, they're having their day at the moment. And they were always going to have it sooner or later. That's the thing about diversification. You don't know when you'll need it, but you will need it. It's like life vests. So Rennie Ellis over at GCI, who manages DDH preferred income, he's just his yield's about 3.79, and the trick here is, folks, when you're looking at these things, other than duration and credit and quality and all those things that I look at, have a look at your yield to maturity. This is about where it's skating to where the puck's going. Right, the great Wayne Gretzky quote: "I want to skate to where the puck is going." Right, and if you have a look over there, Rennie's yield to maturity is 4.78. And we know that because he has to report it. I've got a copy of his report. Unless he does anything stupid, his yield is going to rise, or something serious in the market changes. And if you go and have a look at Richard Quinn down at Global Income there, he's in the same boat. And then if you put that into context, go and have a look at the argument that says, frank dividends and bank shares and great, fantastic. Well, they're all they're trailing the guys at Bentham right now, and you'll see the tax lotto balls are over there on the on the right, and the reason is because you've seen Westpac, NAB, and a heap of other companies say there is no dividend. So this is the historical 12-month dividend, and we know dividends are being cut by around about 30%. In fact, the active equity guys could probably give me an update on that. So the point being, those clients who don't have properly diversified portfolios currently can't feed the dog because the Free Savoy Bank is not sending them out a cheque. So Rover's starving, and Rover's starving because of a bad asset allocation.